Hello, everybody, and welcome to the Mouthy Money podcast. Today, I am flying solo. Chris is away, but I am very, very pleased to be joined by an excellent guest. I'm joined by Clare Moffat, who is a pensions and tax expert at insurer, pension provider, Royal London. I guess there's a bit of both in that. Is that right, Clare? Hi, welcome to the podcast, I should say, as a starting point.
Well, it's lovely to be on the podcast. Thank you for having me. So, yes, they're an insurer and we provide pensions. It's a mutual, so we're owned by the members, so we don't have any
Okay.
shareholders. So we're a bit
Yeah.
different from other insurance companies.
Yeah, I think mutuals is something we've talked about in the past. Actually, it's quite an interesting topic area, but that's not for today. Well, Claire, you and I had a little chat before we got together to do the podcast, and we realised that at Royal London, what you do is you talk to a lot of people about their pensions, and you come across so many different questions and topics that people just kind of want to know about because pensions are such a it's almost like a strange thing where people just don't ever feel like they really know enough, they don't feel engaged enough, right? um so today what we're going to be talking about is we're going to be talking about the questions that you've always wanted to ask somebody who really knows about your pension and about different aspects of pensions and this kind of thing. So we're going to get really stuck into that. Before I do, though, Claire, just tell us a little bit about your background, your kind of experience, and tell us a bit about Royal London as well.
So, my job at Royal London is not really to talk about Royal London's products at all. So, what I
Yeah.
would do is help um, consumers in general. So, it doesn't have to be customers of ours, advisors, employers, employees who understand pensions. And I think, we were saying it's people see pensions as a really tricky topic. And I often talk about what I do as being a translation service as if it's a foreign language. So, trying to make it understandable to people in general. And so I love this. I get to write some articles, I get to talk to the press as well. And yeah, it's really good fun. By trade, I'm a pensions lawyer. I
Oh
left that
wow.
behind a good few years ago. It was kind of not quite as creative, could we say.
Hmm.
So I would write a lot of documents, but this is a lot more interesting. And I feel like I really get to help people to help explain what saving into a pension or taking money out of your pension means. So
Yeah.
Royal London, as I said, is a mutual. And one of the things that's great about a mutual is they've got a really long-term view. So financial resilience is a huge topic for us. So we want to give people the understanding so that they can know what's going to happen in their retirement or during their life as well to sort of protect them against life shock. So I really like that I get to talk about things that don't make Royal London any money at all, but really kind of help in general.
Yeah, that's great. So what we did is we asked you to have a think about kind of the sort of five things that really people just comes up time and again, because obviously there'll be people listening or watching today that will almost certainly have questions about their pensions. And I think it's so easy for those of us who work inside, financial media, the financial services industry and that kind of thing. It's easy for us to get very bogged down in detail and complexities about pensions because pensions is such a complicated topic and there's so much going on. But really, you find that actually that there are kind of, well, we've pulled together a list today and we're going to go through that list of about five things that people always tend to ask when you get to meet them and speak to them. So let's not beat around the bush any further. Let's dive in with the very first one. What is the first big question?
So about paying into your pension. So this comes up a
Yeah.
huge amount. How does tax relief work? And how does paying into your pension work essentially? And
Mm.
we do a lot of research, and some of our research finds that actually about a third of people don't understand tax relief. Now, in its very simplest form, tax relief is just that top up you get from the government. It's a real benefit of paying into pension. So it's one of these things that it's understandable that people don't understand it in full. It's,
Yeah.
because it kind of seems a bit alien in a way. But I think it is about making it simple. So you said, there's a complexity around pensions. And I think part of what we have to do is remove some of the jargon and just explain it in a way that actually normal people would talk about. Now, some of the reasons we have these complexities is pensions legislation is really tricky, but we can take that and make it certainly more understandable. So when you pay into a pension, um, you put in money. If you're employed, your employer will put in money, and then also you'll get tax relief from the government. Now, for if you're a basic rate taxpayer, then you'll get a 20% top up on what's going into your pension. So that's a real benefit because it's making your pension bigger. One thing to say that, I always mention is if you are a higher rate taxpayer, additional rate taxpayer, or there's other other bans in Scotland, um, then you might have to claim that money back from HMRC. So ask if you're in a workplace pension. There's different types of workplace pensions, but ask because you don't want to be losing out on that money. Now, if you're in one of those types of pensions that you have to claim it back, you'll get it back as kind of money. You'll get it back if you do a tax return that way, or you can phone up and ask for it back. It won't go into your pension. If it does, so if you get the benefit of you might be in, say, a public sector pension or a scheme that kind of operates in a similar way, then you might actually get the full amount. So if you're a 40% taxpayer, you might actually get that 40% tax relief when you pay into your pension. So essentially, that means that if you pay £80 into your pension and you're a basic rate taxpayer, then £100 will go into your pension. Now, that's before any employer contribution. If it happens in that way and you don't have to claim it back and you're a higher rate taxpayer, you're going to pay £60 in, but £100 will go into your pension pot. So there's a real benefit to that. And, I think another sort of linked question we often get is, I can't afford to put much into my pension. I'm only in my 20s. What's the point of paying into my pension? And I would always say there's something you might hear about called compounding. I just call it the magic of time. Starting off paying small amounts into your pension is really beneficial. You don't have to be paying a huge amount in, but there's, a couple of reasons. One, it gets you into the habit of money coming off your pay every month and going, into what really is just your future bank account. That's the spending money you're going to have in retirement. And the other thing is, if you start paying into your pension when you're 22, then, and you don't take money out of your pension until you're in your mid 60s, see, that money, even though it might have only been £20 a month, that's had that magic of time. So it's grown, it's had investment growth when it's in the pension. So, start paying as soon as you can and just get into that habit of paying in. And you will get that tax top up from the government, which really helps too.
Yeah, and there's quite an important point here as well, topical element to this, where obviously people are not hugely necessarily hugely aware of a vague idea of kind of the fact that they get tax relief, but more and more people are moving into higher tax bands at the moment, aren't they? Because those tax bands aren't increasing with inflation. They haven't done for several years now, and it's an effect that we call fiscal drag. So more and more people are actually tipping into that higher band and might be due this tax relief. And as you say, they have to go back and claim it potentially without realizing. So that's quite an important point, isn't it? Got to go and check, make sure that you're getting
Definitely.
the tax relief that you're owed, basically. If you some in workplace pensions do they do it at source? I can't remember.
Yes, so if you are in a workplace pension that uses something called salary exchange, now that is where
Right.
you kind of exchange some of your salary and your employer pays not just their employer pension contribution, but also the part that you're kind of giving up, then you
Yeah.
would get that as source. So you don't have to claim it back. But I would say ask your payroll department or ask your HR how it works because don't miss out on
Yeah.
potentially having
100%.
this money. Now you can claim back for a few years before as well. So it's always worth doing. And you're quite right. We've had frozen tax bans, we've had a frozen personal allowance. We're seeing more and more people paying higher rate tax. If you're
Yeah.
in Scotland, you pay higher rate tax when you're just over 43,000. So the rest of the UK, it's about 50,000. So it's, actually a lot of people now are moving into that because we've seen, pay rises increasing in the last few years as well. So don't lose out on money that you could be getting.
Perfect. Right, let's keep going through this list because it is all really interesting stuff. What's number two? And you told me before that this was about 10% of the people on your last chat were actually asking this question.
So again, this is one of the most common things we're asked about, and it's should I transfer or switch or consolidate? We've got lots of different words, but that's essentially moving one pension scheme into another one. Now, so say you have had a few different jobs. And they're the type of pension. Now, again, these are some horrible jargon terms, but the type of pension that we call defined contribution. Now, that just means you pay in, your employer potentially pays in, you get that tax relief I mentioned, and then it builds up into a pot of money. And at retirement, it's your choice what to do with that pot, and you have to make that decision. Now, that's different from defined benefit pensions. Now, again, you might have heard of them called final salary or career average. Now, the majority of people who would have those would be in the public sector. So, so I'll talk about that in a second. But if you're in one of these defined contribution schemes where it's a pot of money, each job you've had, you've probably been in the pension scheme for that job. So you might have 3 or 4 different pots, and we're finding more and more people have multiple jobs. In years gone by, people might only have 1 job or 2 jobs over their lifetime. But we're, finding people kind of in their 30s might have had 4 different jobs. So you have these 4 different pots of money potentially. And it's understandable that people say, well, that's kind of there's 4 sets of paperwork coming in. I don't really understand. Is it better that I should move them all into one? So I would say sometimes, and that often is the answer when we talk about pensions, unfortunately. I think if you are in one of these pensions, defined contribution, you're perhaps a bit younger, 20s, 30s, even kind of 40s, then moving them together, well, that could work for you from a life admin point of view, but you have to be careful of where you're moving the money to. So you have to look at those different pots and think, well, actually, what are the different charges I'm paying? So that would be on the paperwork you've got from your pension scheme, or you might have an app for each of those. So make sure you look and are moving it somewhere that's going to be good and you're not going to pay more in charges. Also, you want to stay in your current workplace pension if you're getting an employer contribution, because normally employers will only pay into that one. So that's the sort of main things to think about there. If you're a bit older, then you might have had pensions that came with special sort of rights. Now, that could be being able to retire earlier. So sometimes maybe at age 50. So there are some people that still have that right. You wouldn't want to lose that. So it's really good to take, advice about that. Also, you might be entitled to um, sort of in the 1980s, there were pensions that gave you things like 100% of the pension as tax-free cash. So you might not want to lose out on that. And there were also other kind of pensions that they came with these extras. So just be careful that you're not losing out on something that's really valuable. Now, you still might want to move because there could be other reasons, but investigate, do a bit of research about these different pensions.
Yeah.
If you are in one of these public sector schemes that I mentioned, you can't transfer your pension. So you cannot transfer unless you're in the local government pension scheme. And that's because there's actually a fund there. They call it a funded scheme. So there is money and you can transfer. For most people, it is not a good idea to transfer out of one of these schemes. And that's because when you retire, you take some tax-free cash and then you have a guaranteed income for the rest of your life. And if you die first, potentially your spouse's life. So it's, a really amazing benefit. These pensions are really good. The other pensions, apart from local government, then you can't transfer out of them anyway. So that's the pension you're going to have. And that's because there isn't actually any money in these funds. So the people who are paying into them today are essentially paying for the pensions of those who've retired. So that's the kind of 2 different types of pensions. So I think it's about doing some investigation. It's about thinking about kind of how your life works and whether you want the kind of ease of having one pension. And, for a lot of us, that is good because it's just having to have one app on your phone, or it's just having to have, um, one set of paperwork to look at every year. But before you do anything, make sure you're not losing out on anything, which is a really good benefit.
Yeah, and before we move on to the kind of the third question, I'll just kind of add that, and this is the gentle disclaimer that we tend to give on the podcast with transferring pensions, particularly for those who've got kind of larger pots and who are further down that line, might have some of those guaranteed benefits. It is worth considering getting, considering financial advice if you're in a position where you kind of looking at, how to structure and what the best options might be, just from the perspective of making sure you don't get it wrong. It can be difficult to make a decision, so it's worth considering kind of
Definitely.
professional help in that regard. But that's brilliant, Claire. Thank you. Number three, talk us through this one. And this is something I love to talk about. Tax-free cash. It's always got a nice ring to it, right?
Yeah, so tax-free cash is another one we'd asked about a huge amount. And also what you do with your money at retirement. So we spoke about kind of paying in at one end, and this is actually when can you take your money out. So the first thing I think to mention at this point is currently you can take out money when you are 55 from a pension. Most people can take money out of their pension when they're 55. So as I mentioned, some people might have a right if you are in certain jobs, then you might also be able to retire early. So the police, armed forces, for example, you might see that they can take money out sooner if they retire. But for most people, it's currently 55. Now that is going up in 2028 to 57. So, we talk about that a lot because we want people to be aware of that and not think, try to take money out in 3 years' time and actually they can't. They've got to wait until they're 57. So being prepared is good. Tax-free cash is another benefit of pensions. So you get that tax relief on the way in, but on the way out, you get 25% tax-free. So that's great news. The other 75%, so something has to happen with that. So you can either take it out as a cash lump sum where 25% is tax-free, but you also get the other 75% at the same time. Now that will be taxed. Now, if you're 55 and you're still working, you probably don't want that 75% that's going to be taxed because it's going to sit on top of your earnings. So for a lot of people, if they're taking money out of their pensions because they want access to some of their tax-free cash, they'll often move it into drawdown. So drawdown it works a bit like the pension you pay into. It's invested. You can stay with the provider you're with, or you can move it. And I would always say it's worth speaking to an advisor because you've got to really think about is how do I make this money last for all of my retirement? So when that other 75%, you don't have to take it though. So in the same situation, if you're 55, you're still working, you can take your 25% tax-free cash and that other 75% is going to go into that drawdown pot and it's going to grow hopefully over the years. And then maybe when you stop working, you start taking some money out, or maybe you go part-time, you start taking some money out. So that's a good option if people want to access some tax-free cash but are still working. The other main option is buying an annuity, which, before pension freedoms 10 years ago used to be really popular, isn't as popular. So an annuity works a bit like those pensions I spoke about for people in the public sector. You buy an annuity with that 75%, and it gives you a guaranteed income for the rest of your life, and potentially if you paid for it for a spouse or partner too. So and it's interesting, we saw people moving right away from annuities. Actually, sometimes it's good to have an element of, guarantee that actually some of perhaps your everyday expenditure is covered. But again, you wouldn't really be thinking about that at 55. That's often good to think about when you're a bit older and you want to make sure that you're going to have enough for the rest of your life. But one of the most frequent questions I get asked is, can I take 25% tax-free from each of my pots? So say somebody has those 4 different pensions, and the answer is yes, you can take 25% of each pot. That is absolutely fine. And what you can't do is take all of the money out of one pot. And that's because every time you take tax-free cash, something has to happen with the rest. Now, what we found in some research we did recently was actually about 1 in 4 people who were taking out their tax-free cash were putting it into a bank or a savings account. Now, I think this is often because people, when they can access it, they think, well, I want to access that money and I want to have it somewhere where I can see it. It's a bit more obvious. But the problem then is it's not sitting in as kind of tax efficient wrapper. It's sitting in a bank account where you could be having to pay tax on the interest. We spoke about more and more people being higher rate taxpayers, so they don't get as much interest tax free. So that's something to think about. And actually, what I would say to people is, say you've got £100,000 in your pension pot. You reach 55 and you think, I really want to have an amazing holiday or put in a new kitchen or buy a car. Um, then you don't need to take £25,000 out of that £100,000. You can take what you need. So say you took £10,000 out because that's what you wanted, that was going to pay for your kitchen. You can take that out, and the other £30,000 you can move into drawdown. So that just in the same way that moves across. But the money that's left, so that's £60,000 in your pension pot, if it grows, you'll actually get more tax-free cash because you'll get 25% of a higher amount. So don't feel you have to take all of your tax-free cash at once, especially if you're still working. Remember that the reason we have pensions is to provide for your retirement. So just kind of take out what you need. And you can actually take out tax-free cash on a monthly basis as well. So you don't have to take it in a lump sum too. So again, it's good to take advice if you can. But just have a think about it, and think about things like the tax implications. We found that a lot of people didn't think about the taxation, and I mentioned those cash lump sums, especially if you're working, it's not a good idea to have that amount of extra taxable income. So, have a think about how you want to take money out, and what you're going to do with that money before you take it out.
Yeah, and there's other rules that people are not aware of as well. Things like the money purchase annual allowance, right? Which,
That's
as
right.
soon as you take some of that money, then the amount that you can then, and if you're still in work, this is especially important because it then massively reduces the amount that you can actually put into pensions moving forward, and that's a permanent thing, right? So it can
That's
be a
right.
mistake, and it can cause problems, can't it?
Yeah, so even if you took one of those cash lump sums, and even if you took £100 out, so you'd get £25 tax free and £75 would be taxed, you would trigger the money purchase annual allowance. Now that is £10,000 a year. So, and that's because you've accessed some of that money flexibly. If you just take your 25% and move the rest of your money into drawdown, you don't trigger the money purchase annual allowance. So it's another good
Okay.
reason not to, if you're still working and still want to be paying in. And actually, we've found that people in their 50s are paying the most into their pensions because retirement's a bit closer. They can see it almost. So it's a good idea to think about that. So again, it's sort of thinking about the tax implications. £10,000 a year is quite a lot of money to many people, and they might not be paying as much as that. But it's also the point in life maybe where you might have got an inheritance or other things, and you might want to pay a bit more into pensions. So yeah, that's another good reason just to take tax-free cash only and not take any taxable income. As soon as you take £1 of income from drawdown, though, you will trigger that money purchase annual allowance as well. So that's
Yeah.
worth thinking about. If you've got a defined benefit pension, because lots of people have a bit of a defined benefit and they have defined contribution pots of money. If you take a defined benefit pension, you do not trigger that money purchase annual allowance. And there's one other good reason. We spoke about transfers and moving pensions together. There's one which I didn't mention at that point, but is really fits in with this. You can take up to £10,000 from 3 small pots of pensions. So it could be a good reason to leave small pots. Now, when you take out that £10,000 from those small pots, you don't trigger the money purchase annual allowance. So you might have £150,000 in one pot and 3 pots at kind of 7,000, 8,000, 9,000. So if you could take all of those pots and you wouldn't trigger that money purchase annual allowance. So it's complex when you look at some of the taxation around pensions and what happens, but it's just about doing a bit of research. Your provider will tell you if you phone up and ask to take money out in a certain way. They'll tell you, do you know you're going to trigger the money purchase annual allowance? And they'll explain it to you. There's lots of great help on the Independent and Government-backed Money Helper website. I'd say definitely look on there and gov.uk just so you have a bit of an idea of how these things work. So again, it's best to do that before, because you might not think you'll spend over £10,000 in pensions in a year, but actually with an employee and an employer contribution, you can get to that at a point where you might want to be paying more in.
Yeah, yeah. I think this probably at this point it kind of illustrates why people get worried about thinking about the pensions because there are all these rules, restrictions, allowances and things that you can trigger and that kind of stuff. So it does really highlight that importance of having that plan around what you want to do and having that kind of trying to take that long-term view, right, of what you want to do with it. And I think this leads us into the number 4 question, which is Actually interesting because we've just had some new stuff out, new information out around it, haven't you? You want to just tell us about that?
That's right. So the next one is, how much do I need in retirement? And, that question is a very personal, well, the answer is very personal to everyone. Different people have different ideas of what they want to do in retirement. We did some research and we found out that most people on average want between 35,000 and 45,000 pounds a year in annual income. But whenever I'm asked this question, I always point people in the direction of the retirement living standards. And we've just recently had an update to these. Now, these are really good because I think they sometimes people want a real idea of what they can spend their money on because actually a sort of saying £35,000 a year, they've no idea of actually, well, what does that mean in retirement? So the retirement living standards are very practical. They say if you could run a car, go on holiday, meals out, things like that. And there are three different retirement living standards. So there's minimum, so that has just decreased actually. So it was £14,400 a year. Now, these don't have any housing costs. So they presume that people have paid off mortgages or aren't renting in retirement. Now, that could change in years to come. And they also presume that tax has been paid. But that was £14,400. It's reduced to £13,400. And that's because there's been a reduction in energy costs. And also, this is all based on research of what people are doing. And people's kind of expectations have decreased in line with this. So if you have passed state pension age, then your state pension is around about £12,000 a year if you get the full state pension. So that would make up quite a chunk of that. So that is for a single person living outside London. So there's different figures for London, and then we'll come on to the figures for couples as well. If you are on that minimum level, it's not going to be high living. So you might be able to go on holiday in the UK for a weekend. You're probably going to have to make some tough choices about spending. How much you can, give in gifts explains that. You wouldn't be able to run a car probably. So, it's not going to be easy on that level of income. Then you have moderate. So that has slightly increased. So it's gone from £31,300 to £31,700 a year. Now, if you were single outside London and that's the income that you have, then you'd be able to take a 2-week holiday abroad, a weekend in the UK, you could run a car. And it even says things about how often you could decorate a room, for example, and how much you could give in gifts to other people. If you've saved enough over the years to get an income of, now that it was £41,100, so this is for comfortable, that has increased to £43,900, so it's gone up by £800. Now, both of these have gone up because of inflation, and that's been offset a little bit by the reduction in energy costs. Now, for that, you could go on more expensive holidays. You can replace your car every 5 years. You can have a meal out every week. So it's very practical. And that's why I always say to people, have a look at these and see sort of what you think. And I don't think it's just for people almost at retirement. I actually think it's for people when they're younger as well to go, well, what extra do I need to do to have that type of retirement that I want? So if I want a moderate retirement, that's the amount I need. What do I need to do now? So, and I mentioned it's different figures for couples now. It's not double, and that's because it's normally cheaper for two people to live than it is for one, because you've not got you've not got double the heating costs, for example. So if you're part of a couple, the minimum level is 21,600, so that's decreased from 22,400. Now, actually, that would be covered by two people's state pension if they get the full state pension. So that's kind of good news from that point of view. If you're moderate, then you would need an income of 43,900. So that's for a couple if they want a moderate lifestyle. And that has increased again too. For a comfortable level, so that's, having those kind of more holidays, things like that, it was £59,000 and it's increased to £60,600. Now, that's a lot of money. State pension for a couple would cover about £24,000 if they got the full amount. But that means saving a lot of other money or having a lot of other money in pensions to have that type of money in retirement. So, but it does give a very practical steer to people so that they can understand what they might want to do in retirement and how much that's going to cost them.
Yeah, and ultimately, this is something that for people who are able to afford it is something a financial advisor would probably be able to help with, isn't it? They kind of look at, what are your expenses today, and your kind of what's your income, how big are your pots, and kind of what other assets do you have because you might have property and that kind of thing that you own, and how can you make all that work plus the state pension to kind of be able to retire comfortably, and what sort of level you'd be kind of realistically looking at. But we have the retirement living standards as well because that helps give people a general idea, doesn't it? But for
Yeah.
young people, it's slightly more complicated because they have to kind of factor in years ahead of inflation potentially as well, alongside what they're contributing, what they kind of think that they might have at the end. Again, it starts to get complicated.
Definitely,
As you
but
said
I
there, though.
think it is
Oh,
useful
sorry, go
just
on,
to
Claire.
have that
Yeah,
that sort of idea. And we know that younger people aren't able to get mortgages till they're older. There will be more people renting in retirement, so that will all have an impact as well. So a lot of people,
yeah,
once they've paid off their mortgage, they've got rid of their kind of main expense, and can actually pay more into their pension because they've got rid of that. So that will change, but definitely financial advice is very personalized to you. They're going to look at the rest of your life, what you like spending your money on, what you like doing. So that is the gold standard. But I think just for
yeah, yeah.
the majority of people who just want an idea, it's good to have a look.
Yeah, so obviously we're not doing a big advert for financial advice here, but I think the reality is ultimately that there are quite a few situations where people, it is a good idea to at least look at whether it would, be work for you in those circumstances. Now, we've alluded to it almost all the way through the episode so far, and this is the one that I think we've on Mouthy Money talked about quite a bit in recent times, especially around things like the long-term affordability of it, which is a slightly different issue, and we're going to talk about it from the other side today. But what is that number five question? And this is the last one.
So we always get lots of questions on state pension. When will I get it? Do I need to do anything to get it? What will I get? And can I get more? So, and I think one of the things I always say is that you have to claim your state pension. So you will get a letter from DWP a couple of months before telling you that you're entitled to your state pension soon, but you have to do something. If you don't do it, then you're actually doing something like that's called deferring your state pension. So that's kind of first tip, make sure you actually claim it if you want it. Some people do decide not to claim it at that point in time. Maybe they're working. So, there's reasons, but you have to claim it. When will I get it? Well, that depends on how old you are. So, from next year, we're going to start to see another increase. So currently it's 66. It is increasing to 67, then 68, and then we don't know, we don't have legislation that says kind of past those ages. So, if people want to retire before that time, then they need to have some other provision in place. So actually, you know, saving into other pensions is a really good idea. I think everyone looks, and I've been quite careful to say a couple of times, if you get the maximum state pension, now this is really important. And we found in our research about a year ago that around half of people get the full new state pension. So that's a lot of people who aren't getting the full amount. So I would always say people should be checking their state pension forecast, especially in kind of late 40s. Um, Recently, we had a big campaign by the government where you could actually top up your state pension, and instead of just going back 6 years, which is the normal, you could go back to 2006. So that was a real bonus. So people could get their state pension forecast. Now you go online to do that. If you've got a government gateway account, you can do that, or set up a government gateway account, or you can phone up as well. Now the gov.uk page on state pension is really clear, explains what you have to do. But when you get that forecast, it will tell you if you've got any missing years. So maybe you worked abroad for a couple of years, maybe um, you had children, they got past the age of 12, which is, up until that age, you will get something called state pension credits or national insurance credits. But after that age, you wouldn't get those, so you might have missing years for that, or there could be a variety of different reasons. Check that, and if you can, it's normally a good idea to top up your state pension. It costs around about, for the last sort of few years, about £900 to get 1 year extra state pension. But you only need to live for 3 years past state pension age for that to be worth it. Now, we know most people are living longer, so it's a really good idea. It's guaranteed. It goes up currently with the Pipple lock. So make sure you're getting as much state pension as you can so that you're getting close to or at that full amount of state pension. So yeah, I think that's the main things that I always say is that kind of check your state pension forecast. Don't be losing out on something that actually, you could do. It might be that you look at your state pension forecast and say you're in your late 40s and you think, oh, I've not got the 35 years that I need to get the full new state pension. Well, that's fine because you're probably going to be working for quite a lot longer. So if you're going to work until you're 67 or 68 in your state pension age, you won't make up those extra years. If you say we're 55 and you didn't have enough national insurance credits or contributions and you stopped work to care for grandchildren, for example, and we see this happening quite a lot, then it's always a good idea to look at your state pension forecast and see how far away I am. If you are caring for grandchildren, you can actually get national insurance credits for that. So it's not well known, but again, there's information on the gov.uk site. So make sure you're claiming those extra credits. So don't, again, be losing out on something that you can get. So definitely check your state pension forecast.
Yeah. Claire, I feel like we could keep going and keep uncovering more things that people really need to know. And I can think of five other things in my head probably, or straight away that we could keep talking on. But I think, yeah, we've covered some really, really interesting areas there. There's so much in pensions. It's so important, and I think we can't emphasize that enough. How much this stuff matters, and actually and this is something we bang on about on the podcast all the time, is just even engaging with this stuff at a most basic level, just so you kind of are aware at a top line, what your pension is doing, what it looks like it's going to do in the future, what your options are, what your goals are, all that kind of stuff. Have that plan in your head. It's so important. Claire, this has been fantastic. Thank you so much for taking the time. I think, yeah, some really enlightening things there.
Thank you for having me.
And thank you, everybody, for tuning in. Do stay tuned. I'm hoping Crystal will be back with us next week, and we've got plenty more guests coming up in June. So please do subscribe and keep up to date with everything that's going on. And with that, thank you, everybody, and goodbye. Thank you for tuning into the Mouthy Money podcast. Don't forget to hit like and subscribe on all our content. Follow us for more on your preferred podcasting channel, including Spotify, YouTube, or Apple Podcasts. Stay in touch by following our social channels on Instagram, TikTok, and LinkedIn. And don't forget to subscribe to the Mouthy Money newsletter on mouthymoney.co.uk. The Mouthy Money podcast is produced for general informational purposes only. It should not be construed as investment, legal, tax, or other forms of financial advice. If in any doubt about the themes expressed, consider consulting with a regulated financial professional for your own personal situation. Past performance is no guarantee of future results. Investments can go down as well as up, and you may get back less than you started with. Never invest more than you can afford to lose. For more information, visit fca.org.uk/investsmart for more. Thank you.